we are back with another Risk Insurance Dialogues interview. Today we have Bo Yu, and he is the Senior Vice President of Catastrophic Analytics at Guy Carpenter. So thank you so much, Bo, for joining me today.
Thank you so much for having me, Katie.
Absolutely. So to kick things off, can you just give a brief introduction of who you are and what your current role is?
Yes. I'm Bo Yu, and with background in atmospheric physics and a PhD in wind engineering, and I had been working across different companies, including the catastrophe risk modeling company and primary carriers, or you can call the primary insurance companies and brokerage companies. So my experience spans related fields, including catastrophe risk modeling, catastrophe risk analytics, and portfolio management, insurance cost allocation, and underwriting, exposure management, and pricing as well. So in my current role as SVP, the Senior Vice President of Catastrophic Risk Analytics at Guy Carpenter, I'm working on technical pricing to support our clients with underwriting with the API solution, the application program interface solution. So earlier I developed the module for for different panel, different region, and then different sub-panels, including the hurricane model. So the hurricane model also including the shock model and the intensity model, and also the storm surge model. And also I have developed the severe storm model, including the tornado, hailstorm, and downburst wind in Australia and the European, including Spain. So I love to turn data into the risk insights and actionable kind of solutions. So with my background, catastrophe risk modeling is a topic I'm really excited about. So Katie, back to you. That's my background.
Yeah, absolutely. And I'm really excited to dive into a little bit more about what catastrophic modeling is and why it's so important to the industry. I know you gave a little bit of an introduction, but can you explain kind of what catastrophic modeling is and what a role in this area of insurance entails?
Yeah. Great questions, Katie. And then let me cover this into two parts. The first part, first a quick overview of the catastrophe risk modeling, or you can call it a CAT modeling, and then what someone in this role actually does day to day or the daily work. So first, what's the catastrophe risk modeling, and then just give you a big picture. So the natural hazard caused the huge economic losses. Just for example, in the United States, and we have the wildfire, we have the earthquake in the West, and then we have the severe storm in the Central Plains, and we have the hurricane, or someone call the tropical cyclones along the East Coast and Gulf of Mexico or Gulf America. So plus the flooding risk pretty much everywhere in the United States. So these hazards hit the business worldwide. And this is what makes the catastrophe risk modeling really important for the smart risk decision across the industry. So simply speaking, catastrophe risk modeling is a computer-based process using in our insurance industry to simulate what's the potential financial loss from the hazard events, particularly for the low frequency and high severity events. So those events give you some example like the earthquake or the hurricane, severe storm, wildfire. So all those kind of events. So insurance company use the catastrophe risk modeling for underwriting, and then for the pricing, premium calculation, for marginal impact analysis, and to managing the portfolio or the exposure, and also for the insurance cost allocation, for dynamic portfolio optimization. So for all this kind of portfolio management. So give you some history of the catastrophe risk modeling. So go back to a few decades ago. So insurance companies still relies on very simple rules like say since like the just multiply the premium by some fixed or constant factors, or just based on the historical loss data, and simply think about what's the catastrophe risk, or I mean, so that works okay for some frequent or the small event, but not for the low frequency, high severity event. Just give the example like the hurricane, severe storm, wildfire, earthquake. So for this kind of storm, for this kind of events, that methodology doesn't work. So as computing powers and natural hazard science advanced, so people start to ask, so can we actually simulate what's the potential loss and what's the distribution, because the distribution means the uncertainty, to estimate what's the loss. So the earlier cut model appears in the 1980s. So but the uptake was still really limited. So then the events like the Hurricane Andrew in 1992, and then the earthquake, North Bridge earthquake in 1994. So those kind of events act as the turning points. So insurance, because those costs are really huge, is something like the many times higher than what the traditional formula has expected. So that's why that really pushed the insurance industry to use the catastrophe risk modeling as an important risk management tool. So since then, catastrophe risk modeling has developed from the very simple experience-based tools into advanced platforms or the tools. So this is some history of the catastrophe risk modeling. So let me discuss about a little bit about what's the key components within the catastrophe risk modeling. So there are four key components in catastrophe risk modeling. So the hazard components, exposure components, vulnerability function components, or you can call it vulnerability function module, and the financial module, or you can call it a financial engine. So you can think about the catastrophe risk like factory lines, so including 4 key stations. Then they work together to turn the hazard or the disaster to disaster physics into the dollar losses. So the first component is the hazard components. So the hazard components just simulate what and where is the hazard, or you can call it the peril, including the frequency, including the severity of the different perils, like the hurricane, severe storm, wildfire, and then the earthquake. Just for example, for the hurricane, so what we typically do, so based on the historical data, and then the historical data including the events, location, paths, and seasonalities. So we simulate with different distribution, like for example, we use Poisson distribution to simulate what's the frequency for the United States hurricane. So the average annual rate is about 1.7 landfall hurricane in affecting all our United States. So and then based on all those simulations, and then we do typically more than 10,000 simulation a year through the Monte Carlo simulation methodology, and then to generate the stochastic event set. So that set including many different events, or you can call it the storms. So including the tracks, intensity, all those parameters, like say, where's the location for every 6 hours or for every 3 hours, and what's the latest maximum wind, and what's the central pressure. All those information will be in the stochastic event set. So, and based on those event set for individual storm, and then we incorporate with the hazard module, like for example, for hurricane, we have the wind field model. So we generated the local intensity. That one considered the local condition, like say the local roughness events. So we convert those stochastic event storms with the wind field model to generate what's the local intensity. So the hazard module tells you the peril types, and the local intensity. So the second component is the exposure components. So this one tells you where is the exposure, the location. Like you can think about our property, the whole the structure, the building features, including like say what's the occupants, construction type, year built, number of story, square footage, all those kind of features, and also some replacement numbers like say how much for the TIV, the total insured values, and what's the coverage, and so on. So the exposure tells you once the event happens and which property are at risk, and then where they are, and what are they looks like in terms of the building features and the replacement values. And the second component is the vulnerability function, or you can call it the vulnerability modules. So this is about something like the damage function or the damage curves. For example, giving a 120 miles per hour wind, what will be the damage for the wood frame house or versus the concrete condos? So this is the curves tells you, say, what's the damage function, vulnerability functions. So the damage curve, we usually divide this one from the engineering testing, based on the claim data, based on the post-event service, all those different resources. So the third component just tells you, see, what's the damage curves based on the hazard information and based on the exposure information. And then we have the final one, the financial engine or financial module. So this one will convert all those physical damage into the insured loss by applying some policy terms like say the deductible or the limit at a different level, like by location by coverage, by side, and then deduct the limit by say at the account level or the blanket deductible limit, all those information. So finally, through the financial engine, what do we get? We will get some loss metrics like the AAL, the annual average loss, or the PML, the probable maximum loss, or the TWA, the tail risk. So all these numbers, I mean, the underwriters or the risk managers relies on. So when they make the underwriting, pricing, and the risk management, decisions. So to answer your question, the second part, what's the typical days of the catastrophe risk modelers? So in a typical days, a catastrophe risk model or cat modelers, so the focus on will be the reviewing all those data and then run the model. We usually license with different vendors. So, and we will blend all those numbers and analyze all those output, the loss numbers. And then we'll hope the business teams understand the risk behind the portfolios. Is either the risk profile or the risk concentration, and what is the loss, what was the key driver of the loss, like say key driver of the loss for the expected loss or for the PML for different time period of the year, or what's the key driver for the capital. So it's really about to turn in the data science into practical tools for underwriting, pricing, decision, and portfolio management. So if we come back to the big pictures, catastrophe risk modeling is built on those four core modules or components: the hazard components, exposure components, and then vulnerability function and the financial engine. So they all work together to turn in the hazard scenarios to the loss metrics and help us with pricing, risk selection, portfolio management. So within that, I will hand that one back to you, Katie.
That's great. Yeah, it's so, I know that it's such a complex part of our industry, and it's great to hear the breakdown of, exactly what the key components are and how they play such a large role in the industry. The next question I wanted to ask you was, I know since it's somewhat of a newer area of insurance, how has it changed recently, and what do you anticipate the change looking like in the future?
Yeah, that's a great questions. Yeah. So I would break down my answer into two parts. And first, I will talk about how catastrophe has changed recently, and then the second part I will share what I think this field might look like in the years to come. So how has the catastrophe risk modeling changed recently? I would share a few key changes I have seen in this field. So first, the traditional catastrophe risk modeling has been used and helped us since, as I said, 1980s. So, but the climate change and climate variabilities and the rapid growth in the population, exposure, and urbanization has shifted all those risk landscapes. So in recent years, cat modeling has also shifted from the backward-looking and historically based methodology to the forward-looking, physical-based methodology. So that says, so to incorporate more like climate different scenarios, IPCC, SSP scenarios, and exposure scenarios, and then to find what's the loss distribution under those different scenarios. So I would say model now capture all those correlated and compounds risk very easily, and use very dynamic climate adjusted data to provide more loss perspective for the under all those different scenarios. So this is how I see the catastrophe risk modeling changes in the recent year. So now let's turn to what I think in the field might looks like in the years to come. So I see the catastrophe risk modeling because more holistic way and dynamic ways. So my understanding is that so in the future, catastrophe risk modeling will get more get stronger, at least in the following two ways. The first one will based more on the physical modeling. So this is the physical risk modeling still represents the key development of the directions. So under those support from the global climate model, the GCM model, it will be better to capture the multiple parallel compound risks and then for cascading storms to better capture all those inside of the correlations. So the second one, it will become really high data driving AI integrated system for long-term risk analysis. So the model will become more transparent and with high resolution and high speed and with very high quality. So this is, I think that I wrapped up my thought for now. So I will hand the one back to you, Katie.
Yeah, no, that's great. I think it's interesting because I know there's going to be so many changes in the years to come, and as we get more data and we're able to predict, more exact catastrophes, I think it's great to kind of hear the breakdown of how that's going to play a role. Yeah. Our last question to wrap things up, I wanted to ask if there's a piece of advice that you have for maybe some young professionals that are looking to go into catastrophic modeling or, to go into this field of insurance, or is there any pieces of advice or tips that you have for them?
Yeah, sure. Yeah. And if you are thinking about the career in catastrophe risk modeling, and if I could give one piece of advice, so the following are some things that I found really helpful to focus on earlier on. First one is, catastrophe risk modeling combines all those science, engineering, finance, and data analytics. So anyone can become catastrophe risk modelers if you are interested. So a strong foundation in mathematics and statistics just make it easier to understand the different model for different parallel, subparallel, instead of simply run those models. The second one is if you want to go deeper into catastrophe risk model or the catastrophe risk research and development, the CAT R&D, develop your data and programming skills will make it much easier to handle all those data sets and understand how those modules actually work. And the third one, I would say the ability to explain all those risks in really simple terms, because in the end, it's not about the model itself. It's about to using those models to help people to understand all those hazard risks and then to understand what's the loss, and then what's the loss distribution under different scenarios to managing all those risks. So for me, the most important thing I would say is stay very curious about the science behind the hazard, natural hazards, and to keep learning. And then because the field never stops changing. So I think this is a good place to pause and then hand it back to you, Katie.
Yeah, that's great. I think being curious is such a key skill, especially in these areas that there's so much research and development. Like you said, it's there's lots to be discovered and lots that's changing all the time. So I think that's a great tip. And that was our final question. So thank you so much for joining me today and taking the time to speak with me.
Thank you so much, Katie. It has been great to chat. I really appreciate this chance to share a little bit about catastrophe risk modeling. It's always exciting to see more people getting interested in catastrophe risk modeling, and I hope this was interesting for listeners.
Yes, thank you.
Thank you, Katie.